Hello, friends. This is Vijay Bhambwani, and I welcome you into the 164th edition of the weekly market roundup video podcast. Well, last week in my podcast, I discussed how the month of January may not see the FIIs rushing into the markets, and therefore the exuberant expectations that the rally would extend itself without any correction was a little stretched. And sure enough, the markets paused for a breather. Now, in this video, I want to discuss whether SEBI's announcement of a ban on naked short sales is likely to impact the markets significantly or not. Well, last night I got an update on the media that SEBI has banned naked short sales, and institutional traders cannot square up their transactions on an intraday basis. Any purchases that they take have to result in taking delivery, and any sales that they initiate must result in institutions giving delivery. Well, nothing has really changed in this announcement because institutions were, anyway, as per the securities law in India, not allowed to trade or square up. And as far as retail traders are concerned, they had to basically resort to stock lending and borrowing in the cash segment if they wanted to short any stocks. The other option was if they wanted to sell something which they did not possess, they could sell it by 9:15 in the morning but square it up before 3:30, failing which any sale not squared up and not resulting in delivery would be auctioned in T plus 2 kind of time frame. So, to that extent, nothing has really changed. And in the FNO, the permitted securities are anyways available for short selling. Now, what if there is naked ban on naked short selling in the FNO space? Would mean that you're selling anything for which you do not own stocks. Well, there is a way out here as well. XYZ companies' futures, which are in the FNO list, and you do not own stocks of the XYZ company. Well, what you could do is buy deeply, really deeply out of money call options, which would be available for a pittance, maybe say 50 paise or 1 rupee per share, and kind of go short on the futures later, because that would result in a delta neutral strategy or a hedged trade and not a naked unidirectional short. So you see, there is a way out of this, and therefore I do not think that the markets are going to be unduly perturbed by this ban on short selling. This ban is nothing new on FIIs and individuals in the spot segment, in the delivery based stock segment. It was already in place. Just what is new is that brokers will now have to report to the exchanges about any client's shorts. So that extra work is a new point here. Now let's return back to our usual weekly kind of analysis that we do in the market. And coming up on your screen is the weekly market roundup window. As you can see here, the Nifty was basically outperforming the Bank Nifty by falling less. And it was the strength in the US dollar index, which is the Dixie, which has triggered some amount of profit taking in the emerging market space, including India. The strength in the dollar has also resulted in the weakness in bullion, and both gold and silver saw profit taking, more so in silver because of the extra volatility that silver usually offers. Oil and gas went up along expected lines. As a matter of fact, on 10th of December, I had basically put up a free Telegram update as to why oil and gas would be free gifts from Putin as an Xmas or a Santa Claus gift, at least till elections in Russia are initiated on 17th of March 2024. Sure enough, oil and gas prices are higher. What is a game plan here is something I have put a hyperlink to our Telegram channel in the description below this video, as well as in the pinned comment below this video. Do take a look at that, please. And do join our free Telegram channel. That's where I put all of our research work under one roof. So oil and gas rose, and what you are seeing is the USD INR, which is the United States dollar versus the rupee, fell 4 basis points, which means the rupee gained a little bit of strength, in spite of the fact that the dollar rose against the global basket of currencies. The 10-year benchmark bond yield went up by 5 basis points, which means bond prices fell. Now, that had a mark-to-market loss impact on banking stocks, which is one of the many reasons why the Bank Nifty surrendered 0.28%. The NSE market capitalization was up by 1.41%, which means the broader markets were sort of okay. It was the index heavyweights which were experiencing weakness. Market-wide position limits, or MWPL, went up 6.31%. That is routine after expiry, and we are going to see that in greater detail. The US headline indices fell across the board, with the technology-heavy NASDAQ falling the most, and that is basically providing headwinds to our local markets as well. Friends, the weekly market outlook done. I now come to our in-house indicators, starting with the MWPL. And what you're seeing is a weekly chart of MWPL across 20 weeks time frame. And the gain after the customary decline on expiry, the MWPL has risen to 35.94%, which basically is the lowest in the last 5 derivative cycles that are covered by this chart in the post-expiry week. So I think the traders were kind of cautious because the markets are near their all-time highs and their risk appetite has shrunk a little bit, which is why the markets are pausing for breath and showing signs of indecision, more of which I will show you in the Nifty and the Bank Nifty segment. Now I come to the index and stock futures turnover. Do remember these are concurrent 3 derivative expiries, which is January, February, and March. And after the usual jump in the turnover due to expiry, now we have seen the turnover fall sharply in both index and stock futures. Although the magnitude of the fall is sort of steep, that tells you that participation levels really crumbled. Part of the reason could be the festive season, the holiday season. People tend to travel a bit, and therefore I would give it a benefit of the doubt, but watch the turnover every day. I update this metric on my social media accounts. Do join me there for free. Now I come to the advanced decline ratio. This is the average of all 5 trading sessions during the week. In spite of the fact that the Nifty has recorded 0.09% declines, the advanced decline ratio has risen marginally to 1.38. as against the prior week's 1.13, which means for every 100 falling stocks, there were 138 rising stocks last week. So the intraday trading sentiments were more or less cheerful, and the advanced decline ratio tells you that one Marshmallow traders were still committed to buying. Friends, I now come to the basis. Now, basis is nothing but the premium in the futures or discount prevalent in the futures as compared to the spot. It's a barometer of risk appetite as well as aggression levels in the market. Just like options premium, basis also contracts as expiry comes closer. Last week, I had told you that the period high of basis in both Nifty and Bank Nifty futures was unlikely to sustain. And sure enough, what you're seeing is a near 45% decline in the basis in the Nifty 50 and a steep almost 30-35% decline in the Bank Nifty basis. That tells you that higher levels were encountering bull unwinding, long unwinding, and maybe a little bit of short selling as well. Now, basis is also something that I update on my free social media accounts. Friends, I now come to the impetus in-house exclusive indicator you won't find anywhere on the internet. You've been depending on this for almost 4 years now, 3 years now. And what you are seeing is that both the indices have recorded a marginal decline in the impetus. So the price was down on a week on week basis, and the impetus also saw declines, which means the falls were basically accompanied by a lower momentum based selling. There was a lack of a panic. There was no panic seen in the market, which is a good thing. Friends, I now come to a second in house exclusive indicator, the LWTD. This is again another indicator you won't find anywhere on the internet. What you are seeing is the Nifty having registered a 0.09% decline last week. The LWTD has come down sharply from 0.66 in the prior week to 0.02 last week. It's barely managing to stay above zero. Now, that tells me that fresh buying might be a little milder compared to the prior week, but short covering at lower levels might continue. All in all, I think the conviction level in the bulls is a little soft. I would want more aggressive buying from the bulls to be able to take the markets to new all-time highs. Friends, our in-house indicators done. I now come to the bond market, which is something I have been covering ahead of equities, and we've been leading the way forward as compared to our contemporaries. What you are seeing is a 5 basis point increase in the Indian 10-year benchmark bond yield, and the yield is now at 20-week simple moving average, precariously poised just below it, but definitely below the upper trend line of a triangle pattern. What that simply means is that the markets were basically, which were hoping for a rate cut coming in to be in a fair possibility in the absolute near future. The traders are basically taking a nuanced approach because now suddenly there are expectations floating in the public domain as to how the Fed may have to pause the rate cuts, the proposed rate cuts, and the rate cut might be delayed a little bit. But look at the four gilt funds that I had recommended on 14th of December. ICICI Prudential Gilt Growth, Kotak Gilt, SBI Magnum Gilt Growth, and Aditya Birla Sun Life GSEC Growth Funds. They are all returning positive, basically returns on capital, although admittedly the returns have reduced a bit over the prior week, but we are still in the money across all four schemes where we have invested. And do remember, this is only the first tranche. This is not something that we've thrown all our money into it at one shot. So we still have the option in case interest rates do not fall and they are hiked as a matter of fact, then we'll switch back and start laddering the sovereign 10-year benchmark bond yield all over again. Do stick with me on my Telegram channel, my free Telegram channel. That's where I update all my trading ideas, and I would update that social media platform ahead of any other. Friends, now the bond market's done. I now come to the Bank Nifty, which fell 0.28%. And last week, it recorded only 1 day of gains out of the total 5 trading sessions. The price remains above its month-long moving average, which itself is pointed higher, which means the short-term outlook is positive for now. But there's been a whole lot of profit-taking in the absolute near term. So what I would want is that the price break out above 48,635 levels before I could say that bulls are irrefutably back in the driver's seat. Now let's go to the weekly chart of the Bank Nifty. What you are seeing is a long leg doji, and the narrow body of that candle is contained within the candle of the prior week's bullish candle. Now, this is a classic inside bar formation as per the Dow theory, the classic Dow theory. The price remains above its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive for now. Like I mentioned last week, the big gap between the price and the 25-week exponential moving average tells you that there was a routine correction likely. And sure enough, we are seeing early signs of that occurring. Now, like I said, 48,635 and above, a new bullish phase might start. On the flip side, any sustained fall below 47,250 levels in the spot segment and the downsides may open up further. Friends, in the week before last, this index was number 4 on our most volatile counters list based on based on statistical beta that we maintain in-house. It slipped 2 notches to number 6, but it's not because the volatility of the bank Nifty necessarily fell. It's because volatility of individual stocks rose higher and faster. Last week, I advocated a range between 49,475 on the upside and 47,125 on the downside. It held perfectly well. In the coming week, I expect the anticipated range between 49,350 on the upside and 47,000 on the downside. Please do watch the daily, weekly, and monthly pivot levels, which I update only on our free Telegram channel. It'll give you a better grip on what price targets to expect in the market. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.09%, and it rose on 3 out of 5 trading sessions last week, and it's closer to the recent all-time high as compared to the Bank Nifty's levels. So, relatively speaking, between the two of them, I think the Nifty 50 is the stronger of them both. The price is above its month-long moving average, which itself is pointed upwards, and the price is also above the Fibonacci level of 21,450, which I had told you is a level to watch out for. The weekly chart on your screen shows a long leg doji, just like the Bank Nifty chart below, which again indicates indecision in the sentiments in the absolute near term. Now, part of the reason could be due to the holiday season, like I said, but a sustained trade above the 21,850 level will remove all doubts about the intent of the bulls and the next leg of the rally to the Fibonacci level of 22,200, which I have been advocating since a fortnight, could become a reality. On the flip side, a sustained trade below 21,500 levels weakens the sentiments further and downsides may open up. Friends, in the week before last, this index was number 9 on our most volatile counters list based on the statistical beta ranking I maintain in-house. It slipped 2 notches to number 11. Here again, it's not necessarily the Nifty's volatility compressed. The individual stock futures volatility rose faster. Last week, I advocated an estimated range between 22,175 on the upside and 21,300 on the downside, which held perfectly well. In the coming week, I estimate a range between 22,150 on the upside and 21,250 on the downside. Please refer to our free Telegram channel for daily, weekly, and monthly pivots to get a better grip on your price projections on an intraday, swing, or buy and hold trading basis. Friends, I now come to the last bit of statistical analysis by way of the contribution of the turnover in the 4 derivative segments by the retail trader. What you are seeing on the weekly chart on your screen is that index futures turnover, represented by a blue line, fell by 4 basis points. Where stock futures turnover is concerned, it is represented as a red line. It was down 30 basis points. Now, do remember, futures are more capital intensive, ask you for more span margin, mark-to-market margin, and exposure and extreme loss margins. They are more volatile than options, and therefore it seems to suggest that risk appetite was smaller. I told you earlier, even in the MWPL, the risk appetite seemed to have compressed. Now let's go and take a look in the lower risk options segment. The lowest volatile options are the index options, and that was the only segment that recorded gains in the turnover contribution. It is shown as a green line, and the stock options, which are shown as a purple line, surrendered a percentage component of their contribution to the turnover. And as you can see, statistical data is pointing towards the fact that there was a very clear risk aversion or lower risk appetite within the trading community. And we need these figures in the futures and options segment to go and contribute higher in the total derivative segment, and the stock options to be contributing higher as well. Friends, I now come to the segment where I share my trading strategy for the week ahead. And now that oil and gas are rising along expected lines, I had told you on my 10th December update on my Telegram that Putin is gifting trades as a Santa Claus ahead of Christmas. The link is in the description and the comment below this video. Therefore, I would wait for some more hot air to blow the oil and gas prices higher before I sort of resort to a theta decay in the non-linear derivative segment, or I would wait for the resistance 3.0 level, 2.5 to 3.0 level on the monthly pivots that I update for free on our free Telegram channel before I would go in for a linear strategic short sale in the far month futures in both options in oil and gas. Now, these trades would be for rollover. They are for extremely patient sort of traders. Now, I expected last week metals to correct lower on commodity exchanges, which actually happened. I would expect some more weaknesses in metal prices on the commodity derivative exchanges. Bullion may see some more long unwinding in the absolute near term, particularly if the dollar index rises, but the outlook remains upwards over the longer period of time. In terms of stocks, I would trade light in stock markets because markets are showing signs of indecision in the absolute near term. If at all I do come across any fresh sectoral idea, I would very gladly update the same on our free Telegram channel. Please do stay connected with me. My contact coordinates come at the fag end of this video. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment segment, do let me know how my videos are helping you become a better trader. Also, help me reach out to a wider audience by sharing my video with your family and friends and social media groups across the board. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.